All right. Hey, trust you are doing well. Just wanted to share some of the things that we're thinking on and working on. You know, of course, the Fed had just raised rates 25 basis points this past week, and I'd been spoke about that before. We knew that that was going to be coming. You know, part of the reasoning that existed there, unemployment has been so strong, roughly 3.5, 3.6%. And the wage growth has been there as well, but also the continuation and or creation of new jobs. The economy continues to run strong, even though inflation had cooled a bit, which, again, provided some measure of pause for the Fed to, pause the rate hike last meeting, the previous meeting, but this meeting they did. And so I want to just, one of the things I've been looking at is with respect to the unemployment numbers. You look at the job growth that existed there, 60% of the jobs. When one of the things, and I just say this, when you're looking at different data points and factors, you want to say, well, what does that mean? What's next? You want to dig into the secondary meaning or secondary factors behind it to begin to understand a little bit more. And so you look at, 60% of the job growth came from government, healthcare, hospitality, and retail. So a good portion of that are the COVID pandemic catch-up realities, where the government, of course, that's a factor of their spending and some of the entitlement spending and things that have taken place and the expansions that they're attempting to do. But then healthcare, retail, and also hospitality. Those are a lot of them picking up the employment that they needed from where they lost with respect to the COVID. And so that's a good portion of that there. And then the other piece is you look at industrial and manufacturing that contributed to those numbers. That's come as a result of the CHIPS Acts and then the previous Biden stimulus in 2021. And so, again, part of that is the economic policy of the Biden administration that's continuing to, pump into the economy, which some would say also helps impact inflation in a negative way. It's pushing inflation along, which would not be the necessarily best thing to do. But so when you look at that and you think about data of unemployment, historically, that is a data set that reverts to the mean. And what I mean by that is that 3.5%, it's not likely to go down to 2.5%. The historical swing is in that 3.5 to 9.5 or 10%. And so there's more likelihood that it's moving toward a higher number than a lower number. So it's part of the equation. There is still a likelihood that the Fed can bump interest rates one more time. But I think the bigger thing that you look at that are two pieces that kind of people aren't looking at is, you have coming up in September, the student loan. There's almost 44 million, 43.8 million student loans coming back online. 92% of those are government backed. So they've been on almost a 3-year no payment pause, anywhere from $150 to $400 a month. So those folks have just completely forgotten about that as a bill. And in many cases, they don't have the resources to pay it because it's like, well, the government's going to forgive it. They've moved on and, strapped themselves into more lifestyle that they can't afford or paycheck to paycheck. So that's going to be a pinch on them as it relates to their spending, which will also, make an impact in the overall economy. And then the other thing, even till you see the stock market has been moving along pretty strongly in the last several weeks, and investors are betting on a better reality. But again, like the Fed historically moves too slow, as we saw on the front side, where they should have been bumping rates sooner, and the government should have been holding back from additional stimulus money, which those factors contributed to the inflation that we've experienced. And then on the other side, they hold high or they advance high too long. And so, the market features are betting that rates are coming down sooner rather than later. And when we look at those data points and the reality of it, I look at it to think, those rates aren't coming down. They're going to hold higher longer. And so that you need to understand that and factor that into the equation, and that's something even too for your business where you may have lines of credit that are variable rate, that's an impact. And so it's not likely that we're going to see those rates coming down in any substantial way this year in 2023. It's more likely that it's probably by, second half of 2024, meaning into the second quarter, into the summer, that we start to see any meaningful reduction there. Just because, again, Powell does not want to be seen as having made grave mistakes or kind of flip-flopping in between. So now, again, we'll keep our eye on the moderation of inflation and see how that goes in the coming weeks ahead. But again, these are some things that you need to be looking at, need to be diving into, and then looking at the secondary piece, not just, hey, here's the unemployment number, but what's it comprised of? What does it mean? And so I just thank you for being a part of our organization. You have a blessed and victorious week, for this is the week God has ordained for you.